think nickel's a tough space.
We're not in business to wash our face.
Wyloo's sitting on like $500 billion of unrealised profit right now in Greatland's stock.
You say billion or
Million. Higher or lower than that?
It's
About that?
a bit more than that.
Bit more than that.
We've done a bit in gold.
Yeah, you got to remember we tried the raid on
I think about
Regis.
this all the time.
I think about it a lot as
I
well.
think-
We look at that share price as well.
You guys ready to go introspective?
Yep. It's got very philosophical. I thought we were just going to talk about Greatland.
Is Wyloo meant to be a miner or a strategic investor in miners? It's a Wyloo IPO inevitable. The most underrated place to be allocating capital right now.
I actually really resent being associated with the term green premiums.
Today we've got two returning guests joining us, Luca Giacovazzi and Joel Turco of Wyloo Metals.
Just in case you live under a rock or maybe outside of Australia and you don't know who Wyloo is, this is the private mining investment arm for Andrew and Luca Forrest. So if you don't know who these people are, you're probably listening to the wrong podcast.
Now, last time Luca and Joel joined us, it was mid-2023. It was shortly after they wrapped up the deal to buy 100% of Mincor. Since then, the nickel market has changed a lot. The project was put on care and maintenance, and we address the decision to buy it and everything about that process in a really, really candid way. Wyloo stayed busy since. Very recently, they've had an enormous win with their strategic stake in Greatland Gold. Plus, they carved out a tidy outcome from the wreckage of rare earth developer Hastings. And we unpack the lessons from each, the good, the hard, the serendipitous. We talk market cycles, deal structuring, and how Wyloo positions themselves as both an operator and an investor in this volatile sector.
Yeah, there was heaps of candor in this conversation. They reflect on some timing mistakes. They also reflect on doubling down on names in which they have high conviction. And also what it sort of means to juggle both the nature of being a mining company, as well as investing in these mining businesses.
This was one of my favourite conversations that we've had all year, JD.
Let's get into it.
Luca Giacovazzi, Joel Turco, welcome back to Money in Mind podcast.
Thanks for having us, guys. Good to be back.
Yeah, good to see you guys.
It's been an highly eventful past couple of years since we spoke with you guys mid-2023. So we've got a lot to unpack.
2 years.
Yeah,
2 years.
Yeah, it doesn't feel like it was that long ago.
How do you reflect on those last 2 years?
How do we look?
Yeah.
2 years older.
I'm hiding
feel 2
the
years
hair
older.
that's fallen out.
Yeah.
That's why you've come in with these R.M. Williams like hats, which is the most expensive merch we've ever been brought by a mile. But it's wicked. But it's been an eventful 2 years for you guys. It's funny looking back like 2 years ago, like when we had that first conversation, and the world looked a lot different as well. It was, nickel. The signs were there, but they weren't quite there. Of what was really playing out over the full course of the Indonesian supply that's come. How have you guys just reflected on the change in the nickel market, not just the last 2 years, but maybe the last 3 or 4?
Yeah. I think nickel's a tough space, and the reason it's tough is it's a very flat cost curve. So, sometimes the problem with nickel is it kind of sits on that cost curve for a really long period of time, and that's kind of what we've seen, I think, over the last couple of months. And I think you're right. When we did the acquisition of Mincor, at the time we had seen the nickel price come off a fair bit, and we thought, okay, are we starting to hit that kind of flat part of the cost curve, and it's going to sit there? And it just kept going. So from that perspective, obviously, it wasn't great for us. Felt like we were catching a falling knife at the time. And I think fast forward now, I mean, you're still seeing a lot of, there's just no supply discipline in the space. You've got, capital to happy to keep building out capacity, even though the price is really weak. Starting to see signs of that disappearing now, which is good. But then you've got a backdrop of, EV sales on the decline. So I think a couple of headwinds there, but starting to see some shoots that things are starting to turn around a little bit. And I think, unfortunately, sectors, some miners need to feel pain before they start to become rational. And I think you're starting to see that a little bit coming through in Indonesia.
Yeah, that was certainly a challenge. It's been a challenging, 2 years with regards to nickel. There's no way around it. I think the challenge that we had is we took ownership of the business. We thought that we'd bought well. The price kept dropping, post acquisition. We were adopting a very lean approach to our operations. We were ripping costs out of the business and just to play catch up. The price was falling as we were taking costs out of the business at the same time. We then got to a point where we were actually had a very low cost base for our operations, to the point where we were washing our face even at a depressed nickel price, but we're not in business to wash our face. So sort of wisely made the decision to, and it's a very difficult decision, obviously, to put the mines on care and maintenance. Looking back on it, what would I do differently? I actually think we executed the deal really well. I think it was like a well executed deal strategy. Would have waited 6 months, done it then, and then I think we'd be looking at it very differently now.
It always looks easier in hindsight.
Always looks easier in hindsight, of course. We still think that Kambalda's got a really bright future as far as nickel's concerned. The nickel market is a challenging one. We are starting to see in Indonesia some of the what I think will go on to become kind of cost pressures that'll sort of eventually start to creep in. We're seeing some of the subsidies and government support falling away. We're seeing royalties increase. Naturally, when you're mining in an area, you start at the best spots with the best access to infrastructure and energy and highest grades, and you're mining nickel laterites, you're mining outward. So I think over time we'll start to see those costs tick up, which will have a resultant impact on the nickel price. But we're still very optimistic about the future of Kambalda. It's not easy, but we're in with both feet. We're committed and actually doing some exciting work at the moment in the last 12 months or so.
When you bought Mincor, no one was in care and maintenance yet, and now everything is in care and maintenance. I like maybe some people saw the nickel supply thing coming, but the extent that it kind of just gutted out an entire,
not as many people who said
industry.
that they saw it coming.
Yeah.
But yeah,
Always the way.
Yeah.
I think like, if there's any kind of learning from that experience for me is it's just really hard to predict how a market will react. A market can be oversupplied by millions of tons and not react as strongly as what the nickel market reacted. It can be oversupplied by a handful of tons and react really, respond in a really sharp way. So I think it's difficult, and I think in mining you're always trying to time the cycle, and sometimes you get it really right, sometimes you don't. I mean, our investments in gold have obviously gone really well. I don't think we can pat ourselves on the back and say, we saw Donald Trump winning the election and wars in the Middle East and et cetera, et cetera. You can have a view on these things, but I don't think you can ever quite get them 100% right. And I think you're just trying to get as close to the top and the bottom as you can when you're making these decisions. But I think for me, that's the biggest learning is, I think you got to wait to see how kind of prices respond a bit more. I think we were just a little bit too premature. Like, we knew there was some price pressure coming in nickel, and we thought, okay, well, this is our moment to acquire this whole asset. And maybe we should have waited a bit longer just to see the full extent of that impact.
Has your thinking on how China dominates commodity markets changed at all? I think if we were to ask that question 2 years ago, like, the influence of China couldn't have been any greater. But if we look across, we'll speak about rare earths later, nickel, lithium, has that changed at all?
Look, I think it's again, like in nickel, the other problem you have is it's so opaque what's going on in Indonesia. You don't really know, and you can read the best research, you can go over there yourself and try and have a look, but I think we underestimated how much supply was coming online, and I think that's the risk you run with kind of Chinese involvement in commodity markets. You don't really have transparency to be able to make a judgment call. I mean, I always look back on it and I go, when we did Mincor, our model, we had weaker nickel numbers than what every broker was putting out, and we were all wrong.
Yeah,
and went way lower than what everyone thought. So I think that's my takeaway from Chinese involvement in any kind of commodity market. I think you guys saw the quote from Gary Nagle saying Glencore will stay away from commodities where there's too much Chinese control. I think that's also a bit of a fallacy, because ultimately China has involvement in almost every commodity in some shape or form. So I think it's hard. It makes decision making hard. But I think for us, we're really focused on actually owning these metal units. I think we sometimes lose sight of that. Like you actually have the physical asset, and over time, commodities are going to go through ups and downs. And at certain points in the cycle, you're going to do really well. At certain points in the cycle, you're just going to have to wear a bit of pain.
One observation I have of you guys over the duration we've known you is even when the cycle's not going your way, you're always trying to find angles or ways to create realize option value that might be latent amid a bad decision or a bad hand. How have you been doing that lately?
Yeah. I mean, you mentioned earlier, like obviously the whole sector's challenged, and that is not great for the nickel sector, but it also does provide opportunity. So we're always looking at ways to grow our resource base, be that organically or inorganically. So it doesn't have to be ownership all the time. It can be partnerships. Like we've shown an ability to be pretty agile across different deal structures. Not everything has to be an acquisition, although I know you love a hostile deal, Trav, but I think we've provided enough fodder for this podcast in that regard. We're also, we can do friendly agreements. We can be a shareholder, we can be an owner, we can be a joint venture partner. So looking and at all times testing different options. Obviously access to processing infrastructure for nickel is a challenging one. So we have been for the last couple of years looking at ways that we can best, either build something new or use what already exists in the area, or can you retrofit something? So yeah, we've got financial model with about 25 different permutations of different production bases, different processing pathways, different paths to market. And then we never sit still for long, and we're trying to keep the rigs turning as much as we can and growing our resource base organically as well. So I think that what we know is that there's definitely a operating cost challenge in Australian nickel. The bigger you are, the easier that is to overcome. The higher the quality of your body in size and grade, the easier that is to overcome. So I think that will be the pathway out of this. I don't think there's any like secret sauce, cost-based rules at the end of the day.
When I think about nickel over the past few years, there's actually two factors. There's the Indonesia implications, and there's also the battery side of it, and the world moving much more towards LFP than I certainly had suspected. How's that sort of playing into the models, and how's that impacted your thinking?
Yeah, I think it comes back to even the comment around China, where you're trying to operate in these really illogical markets, irrational markets, because even within the EV space now, you're starting to see these articles coming out about a glut of EVs in China. They've built a lot of capacity. They're trying to get it exported overseas. I think you're seeing a little bit of that play out with LFP versus NMC. Right now, there is so much overcapacity in LFPs that they are dirt cheap, and it makes sense to use them. I think there is still a very strong use case for NMCs, and I think that's why you still kind of see the market in a 50-50, 60-40 type split. So I think we do try and keep a close eye on kind of how technology is trending and changing. It's hard, we're not battery experts by any means, but I think from what our perspective, we definitely see that there's kind of a use case for both. There's the LFPs, which are really suited to kind of lower cost, low range type vehicles, light vehicles, and then you've kind of got NMCs that are higher performing, longer range, maybe heavier vehicles. You have to use them. So, yeah, and I think that market, JT, you step in on this, but that market has kind of matured over the last 5 years. It feels like we're kind of settling into a bit of a groove of like what's the preferred technology, not changing as rapidly as before. So
yeah, and like Luca said, I'm not don't pretend to be a battery expert. We just consume as much research that other people produce as we can. It does feel like every time I read something, it's telling a slightly different story. I think that zooming out at sort of 40,000 feet, I think we can get a bit tied up in this argument of like, is it LFP or NMC? And I think the answer will be it's both and more and very other battery chemistries. I think that in the same way we have, I think I might have said this before, 4-cylinder, 6-cylinder vehicles will have different battery technologies for different sorts of cars, different sorts of vehicles. But certainly the popularity of LFP batteries is also driven by the popularity of EVs in certain parts of the world. They're more popular in China. The adoption rate in China is much higher than elsewhere in parts of Europe. And in those countries, the vehicles tend to be large cities, so tend to have lower range, lighter, smaller vehicles. I think if you want to have, large parts of the United States driving electric vehicles, I can't see them getting away from their large vehicles anytime soon. So that'll push towards a different battery chemistry. LFP battery tech is certainly coming along in leaps and bounds as far as energy density is concerned. I think that one of the other challenges is also like, what is it, a high nickel NMC or a mid nickel NMC battery? Probably 12 months or so ago, it felt like we were going towards either no nickel or lots of nickels, like high nickel NMC batteries or LFPs with no nickel whatsoever. Then the popularity of hybrids kicks in. Then you're starting to see a lot of popularity now in mid-nickel NMC batteries. So it does feel like whenever we read something, it's a slightly different story. I think that trying to predict where that's going to be in 2, 5, 10 years' time is really challenging. I don't think that nickel is going anywhere as far as a demand case. I think the demand story is really good under all scenarios. You're still seeing predicted cumulative annual growth rates of like 7%. That's good by anyone's measure when you've got a big stainless steel demand still driving the story, and then the kicker from batteries. So I don't think it's going anywhere. But I also think that we don't need all electric vehicles in the world to use nickel batteries in order for there to be a great use case for nickel in batteries. I think that they will continue to exist. Can be a bit frightening to think, what happens if there's a completely new battery technology that comes as solid state batteries emerge as like the dominant EV battery technology? Random. I mean, that's always a bit nerve wracking, but I also think that the incubation period for a new battery technology takes a long time because all of the infrastructure that's built around it, that doesn't just change overnight. Tesla's spending billions of dollars building out battery infrastructure in the United States that's built around a nickel battery. So they can't just suddenly go, switch that off, we're now doing a sodium battery or something like that.
Do you know why Joel Turco said?
We're still very optimistic about the future of Cambalder.
It's because right before he walked into the studio, he just got off the phone with Derek Hurd at Sandvik Ground Support, who told him all about the ground support innovations they could implement at Cassini Nickel Mine when they restart. Now, Derek probably said something like this.
The logistics and warehouse people, you've then got the technical people, obviously making sure the product is the right specification. We have our after sales people come onto the site and they'll do pull tests. So they go on underground and connect a hydraulic device to try and pull the product out of the ground to make sure it's installed correctly. So a bit of a QA perspective. So it's so critical to match the hole size to the bolt diameter, and for us to come along and we'll do a pull test to make sure that has been done correctly.
I'm positive about the future too when I talk with Derek Hurd about ground support. So you should get in touch with Derek Hurd too. Tell him Money of Mine sent you. Back to Wyloo.
Should we talk about Greatland?
This has been a huge win. Wyloo's sitting on like $500 billion of unrealized profit right now in Greatland's stock.
Did you say billion or
Million.
billion?
I heard billion.
I would love $500 billion.
Half a billion at the same time. It's like 500. Anyway, you got $500 billion on one. $500 million though. Is it higher or lower than that?
It's a bit more than that.
Bit more than that, yeah. That's a remarkable outcome, and the large swath of that has come from underwriting the acquisition of Talitha and the other 70% of Havron recently. But that wasn't where you kind of got into the story. You probably don't even get the inside edge or the opportunity to do that unless Wyloo was there 2 years before that with a strategic investment, which at the time was $60 million and a potential for $60 million more via options. So how does that come about originally? What's the initial interest like 2 years ago?
Yeah. I guess we'd sort of both of us had known Sean from his previous roles at Northern Star and sort of followed his move into Greatland and sort of organically started up a conversation with him around not long after he started there. looking at different investment opportunities, and obviously they'd like to have a strong supportive shareholder. Around that time, I think, we liked the story. I think that this was always part of the plan, but a lot of the holes in the wheels of cheese needed to line up for it to work out.
It was still Newcrest.
That's
Who
right,
was the
yeah.
JV partner, and Newcrest and Greatland, they were still playing games.
They were playing games, yeah. There was a lot of cat and mouse going on, which is sort of around the time that it happened.
It's a funny story because I remember when we first looked at it, we compared it to the Tropicana stake, and we were like, "How does this compare to Tropicana?" That was the way we were thinking about it more than, I think at the time we, with Sean, we were always saying, we should go talk to Newcrest. That makes sense for these things to come together. It's an unloved asset in that Newcrest portfolio. But I recall, like, our first bit of analysis was like, this is Trop. This is what Trop's valued at. How does Javier on a 30% stake of Javier on stack up against that?
Yeah. And so I think when we initially looked at it, we couldn't get the valuation to stack up where it was trading at the time. Kind of re-engaged again in mid-2022. Share price, I think that was sort of post some of the fun and games with Newcrest, and we thought the valuation now does stack up, albeit, as I said, a lot of those pieces needed to fall into place in order for it to be the roaring success that it is today. So that was probably reflective in the nature of the investment, like a modest investment in equity, and then some warrants that attached to that.
The warrants were. Is this just like the leverage you have being a strategic investor in an AIM listed like gold mining stock, because there's such little capital, you can get some juicy warrants along the way?
I think it's those warrants came about just from being early investors. We got them when we did the first placement into Greatland, and I think the bits that you don't kind of see from the outside is it's been a 3-year journey. Working with those guys, talking, and you don't see this, but a lot of conversations with Newcrest, then they'd all just fall away, and you've invested all this time and effort into trying to get something done, and then it just fall away overnight, and then you have to pick up from the beginning, start a new conversation with Newmont, try and get the deal done.
The moment that Newmont announced that they were acquiring Newcrest effectively, there was also that disclosure that they're going to seek to realise $2 billion of asset rationalisation the exact same time. So you kind of know immediately this is probably on the table at that point in time.
Yeah. And then they named Javier and Telfer like among a list of the assets we're going to divest. So that was always that was the Greatland plan, but there was no guarantee that was ever going to happen. Yeah. So I think once, even before that happened, when there was starting to be rumours of Newmont Newcrest, we're like, ooh, this probably shakes out, which it did. And then it sort of really became like, all right, this is looking like what we hoped it would look like in 2022. So then we, we've been supportive all along, I think. Sean and his team bring like a lot of energy to the company, and I think they have shown the ability to articulate and execute on a strategy really well. So we were supportive all along. We did the placement in 2022. In 2023, we provided them with a credit facility. That was $50 million credit facility, just to give them some financing flexibility around the time that they needed some. And then as you said, the rumors around what Newcrest happened. They mentioned Javier and Telfer specifically.
It's not like Greatland's, the share price really reflected the potential optimism that could come, because there's still a lot of uncertainty about getting that deal done, right? Like, what are they going to pay, yada yada. And of course the thing that's well publicized now is the amount of leverage they got from the right to wrap their hands around the whole lot for what was, appears now in hindsight a pretty undemanding kind of price paid. But they still had to double their share count in that capital raise, and as an AIM listed like a gold miner, like a raise which I imagine wouldn't have been very easy to do if Wyloo didn't cornerstone it or underwrite a portion of it.
I think so. Yeah. And I think one thing we must say, Sean and Rowan on that deal, I've never met two guys more determined to get this deal across the line. They worked incredibly hard. It's not easy, when you're a smaller miner trying to go to the world's second biggest gold miner and try and buy one of their assets. It's not an easy thing to do, and those two really did an awesome job getting it across the line. But I think to your point, maybe Turco, you can touch on it a bit more. But I think the the thing that we could bring and that we could help was that we could say to Newmont, we'd bring that financial backing to make sure this deal closed.
Yeah, I mean, it was like a rare example of a win-win-win that, you know, Newmont wanted to divest of the asset. They knew that Greatland were the logical owner. The right gave them a lot of leverage, but it was still a really challenging transaction because they had to raise more than their market cap. You know, they, to their credit, accepted a bunch of scrip as consideration. You know, they also needed, you know, some financial. They started to raise a lot of money in spite of that. We could lean in and provide that. You know, obviously the big name, but also the financing support. I think we look back on it now and think, oh, of course, it's a screaming deal. But it was still, I called it before, squeaky bum time. Like there was a few nervous moments leading into that it was, yeah, you know, you're asking for a lot of money from investors who, and on this obscure exchange that no one really knows much of, down under. So
one day we'll have to do like a live podcast the night before a deal, and
Yeah.
you know, there's phone
God.
calls at 1,
Yeah.
2 a.m. in the morning, and you're
Yeah.
trying to get things done, and you know, trying to fill a book that was quite challenging at the time. You know,
But-
it was a. You look back on it now, and that equity raise was done at a pretty steep discount.
30% discount.
Yeah, and that
like
was
4.8
4.8p, yeah.
that was to get it across the line.
Get across the line. Whereas now it's like you can't get your hands on the stock if you tried.
The part that, obviously easy to overlook originally, but is a huge source of the profit to Wyloo. The option to buy, you know, half of Newmont's stock at a fixed price there of 7.2 pence. That's
So 50% premium to the raised price at the time. Yeah.
it's kind of an interesting dynamic, right? Because you've got leverage in getting the deal over the line by getting some upside from the future sale of the shares to Newmont. Like the link is triangular.
Yeah.
It's a clever, neat kind of outcome that managed to stitch it all together.
I think just important to go back to kind of what we were saying before. You know, this deal took a long time to incubate, and I think the one and only role we played was providing that certainty that we could provide that financial backing.
Yep.
The rest of the credit goes to the Greatland team, and you know, I think you know, now it looks, at the time, I think Newmont were happy to say you can take this off of me for a 50% premium. It now looks like we've done a smart deal, but at the time, to Joel's point, was a win-win win for everyone.
Yeah, and at the same time, Newmont took a bunch of consideration as scrip, and that script's now worth 3 times. Like they've sold it in the IPO. Like they've sold that for 3 times what it was issued at. So they've also done astonishingly well. Credit to them for leaning into a pretty creative deal structure that otherwise would have made that deal really hard to get across the line. So just a good gold price just solves everything, isn't it?
Now I understand all that, but I don't understand how the oppies you first got when you tipped in money in 2022, they were called warrants. Somehow when I read them in the announcement back then, when I read them about them in the prospectus, the expiry date had been extended by 3 years. Now, I don't understand how that happens. Like, I've never seen that one before. That's
just neater if everything expires at the same time.
I think, look, mate, I think the option was an agreement between us and Newmont, and then providing the actual underwrite to Greatland. You know, again, at the time, most people would ask for an underwrite fee. We asked for an extension on the warrant terms. So, you know, at the time, I think everyone goes, yeah, that's an easy thing to give away versus cash. But now it's valuable.
Yeah. I also think it reflects the fact that when we were initially granted those warrants in 2022, I think we did the capital raise, the placement at like 8.2p, and then the warrant exercise price was 10p. So it's like a relatively modest premium. And at the time, those warrants, if converted, accounted for about 6% of the register. Whereas, you know, now those 10p warrants are more than 100% premium to the capital raise at 4.8p. And, you know, assuming that the deal gets away, they now are worth 2.5% of the register. So it's sort of a little bit of a balance there. There's a little bit of,
I want some of those warrants. That just you can just extend the deadline.
One in.
Yeah.
I think you got to remember though, like we walked away from a lot of fees at the time, in exchange for those warrants, and it's worked out now. But you know, it could have gone the other way where, you know, we walked away from a fee and had something that's not worth anything.
There's a lesson there in alignment too. Like there's like equities long term.
Yeah.
And the fee is transactional.
Yeah, that's right.
When you were reflecting on the price and the the price tag that Greatland was going to have to pay becomes apparent to you, what's your sort of gut feeling if you can cast your mind back?
Yeah. I think you go through all this work around trying to triangulate around a price. I think, you know, they got very lucky with timing as well, Greatland. I think it's been a great deal, but it's also been a great deal around the timing of it's been really, really good. You got to remember in those days, they'd just taken it over and had just announced a tailings dam pothole that was causing them massive headaches. They had to suspend production. So it worked out well for Greatland because it was an asset that I think was just causing Newmont a lot of headaches. They were keen to offload it. It needed some work fixing the tailings dam. And I think, overall was a good outcome for them, resulted in a big stockpile coming along with the deal, which was good for Greatland just to get started. But at the time, like when they were looking at the price they were going to pay for it, there were also all these issues with it. So
yeah, what I'm really curious about is the the commitment that you already had. You'd already put money, and I would feel that investing my own money, but this is a much bigger scale that you guys are doing it. You'd written big checks, and given the facility as well. Did you feel that same sort of commitment that you have to follow it through?
Well, you went hard. You went hard in the underwrite, and it was the first time I'd noticed you guys go hard since Minkor.
Yeah, I don't think it was I know what you're saying is like, you're kind of 1 foot in. Do you just go both feet in? I don't think that was the case. I mean, we really do look at things, on an individual basis.
Every decision on its merits.
Merit,
incrementally on its merits.
I think the only thing I would say with that was that we do have a very strong view that Havieron is a fantastic asset. And I think we had a strong view that Telfer wasn't getting a lot of love. And, we knew there were things like West Dome Deeps. There was all this potential there that kind of people had spoken about but never really gone and spent the time really investigating. So I think from like a quality of the ore body perspective, we had a pretty strong conviction. But I mean, at the time, and you jump in here, JT, like at the time we were like, this is still a big acquisition for a small company.
For sure.
And, you're nervous when you're doing it.
Yeah, when we, the benefit of having invested 2 years prior is that you're already across a lot of the details of the project. You've got your own models and analysis around it. I think when we're looking at something as big and transformational as this deal was, I like to look at it through the lens of like, what do you have to believe for this to be the downside to be here? So as long as you're protected sufficiently on the downside, then what do you have to believe for this to be a stonker? I'd be lying if I said that I had my model spitting out these sorts of valuations so quickly because we weren't running as an aggressive gold price through the model. But I think what we did look at, we believed in the potential for Telfer extension. We still do believe in the quality of the Havieron ore body. But then we also would run some sort of doomsday scenarios and like, what happens if there is this gap between Telfer production and Havieron coming online? So if all of these things happen and maybe the gold price softens, what's the downside scenario? What's the upside scenario? And I think where we got to on Greatland is that there was like real asymmetric risk profile, a lot more risk to the upside than to the downside. And that gave us the confidence to follow our investment. And you're right, that was our first big swing since Minkor. I think it's a combination of, confidence in our commercial position, confidence in our technical analysis, and then confidence in the known quantity of the company, of the management, of the board, of the technical team. We spent a lot of time with our technical people, speaking with their technical people, led by Simon, who do a fantastic job. And then I think when I look, like, it's obviously been a great deal, and we're chatting about it today, like what's made this such a great deal? And I think it's a few factors that relate to one another. Like one, they've bought really well. Like there's no getting away from the fact that they've bought really well. It's a tried and tested strategy. You buy an asset that shakes out of a major that's not getting the capital allocation and management time and attention in that big portfolio. The gold price has been strong. The asset has outperformed through a combination of having that capital allocation and management time and attention, and a strong gold price giving the ability to look at other production opportunities, other mining opportunities, and then like a bit of that good luck and timing, like the TSF issue, creating this great big stockpile, right before completion that you can pump through the mill. So I think a lot of those things are interrelated, obviously. But ultimately, we look at what do you have to believe for this to be a bad investment? What do you have to believe for this to be a good investment? Where do those valuations come out? And then when something is as asymmetric to the upside as this was, I think it gave us the confidence to go at it.
You're going to do any more in gold?
We've done a bit in gold.
Yeah, you got to remember we tried the raid on Regis.
I think about this all the time.
Oh, I think about it a lot as
And,
well.
don't worry, we look at that share price as well.
How do you reflect on it?
Oh my god!
I think
let's give the backstory because people probably won't be familiar with. This was like
let's not.
30th of June 2022.
It was the 30th of June.
Aftermarket,
Yeah.
and you guys launch a. You've already got 4.9% kind of undisclosed at this point, and you'd launch a fill or kill for another 15%. Baron Joey's like phoning people up for you, and they get to 12. So it's fill or kill, and in this case, you didn't get filled, so it's killed. Do you wish you took the 12 though?
It wasn't even.
Yeah.
I won't tell you what the exact. It wasn't 12. It was decimal places of a percent that we were off. And,
oh really?
Why fill or kill?
Look, I think the one thing that is important to us is if we say something, we stick with it. And, we told the market it's fill or kill. So this is your opportunity to sell your stock at the end of the financial year. And what we don't want to go and do is we say that and then, we'll just take whatever we get. Next time we try and do the same thing, we don't have that track record.
Yeah.
So I think if we say something, we stick with it. We look back on it now, and of course, again, hindsight's 50-50. We would have made as good a return on Regis as what we've just done on Greatland. But and look, I think Regis is a great story. We don't have any shares in it anymore, but similar kind of view on it that that Duketon Bolt hasn't had a lot of exploration, and I think there's more to come from that part of the world.
Regis was so out of favour back then too. Like I remember every bank was pitching defence. The market was hating them for overpaying, drop, and wearing all that with the hedge book at the same time. And gold price fell off, which really complicated all of those factors. But it did take a bit of cojones to be like, no, this is cheap. It's not it's not warranted. This is cheap here.
Yeah, I mean, we looked across the whole ASX gold landscape around that time, towards the end of that financial year, and the whole ASX gold landscape was trading at like reasonable discount to now. And like, I don't know if you've been around mining and gold and punching out gold decks, which I know you did a few of in your time, Trav, and I certainly did a few of in my time. Doesn't tend to trade at a large discount to NAV for very long. And so that was sort of the super macro view. It was like these Aussie gold stocks are trading at a discount.
We took quite
Instead
a
of
few...
sprinkling, we started out, we thought we'll sprinkle a bit of capital around, and then chatting with the rest of the team, thought let's have a big swing here, and Regis was the one. And gosh, yeah.
Hey, it freed us up to be able to do.
I mean, that's the thing. It's a sliding doors moment, right? You always remember the ones that you're like, if only. But then at the same time, Greatland, we got it right, and we got the timing right, and we got lucky with it, and a combination of great execution and good luck and timing.
So you say a macro view, but you're not actually thinking de-dollarization, US debt and these sorts of things. That was only a few months after Russia had invaded Ukraine and assets had been seized.
Yeah.
But it was very much these are trading to a discount to NAV.
I think we look at what brokers were saying on gold price.
Yeah.
I think our view on the kind of more macro side of it was probably a little more driven around. I think the thing we watch a little bit more with gold, and there's not a direct science in this or correlation to it, but we're looking at inflation rates, we're looking at government debt, and we're kind of going like everywhere in the world seems overlevered. We look like we're going into this inflationary environment. Interest rates are going to go up. Gold looks like a sensible place to park some money. Did we think it was going to go as well as it has? No. And are we some like gold savants? Definitely not. No. But it was a bit of that just very, very high level, like where do we think kind of global economies are going? And that's how we made the decision.
Yeah.
And then we just nerds and got into NAVs and gold comps and
You just would have been addicted to those rolling P NAV charts.
Yeah, that's right. That's exactly right. That's exactly right.
What would you have done if you got the 19.9% stake? Like, what would your next move have been?
Hostile takeover? No.
No. Look, I think again, look, we don't know the business well enough to kind of tell you what I think the strategy would have been. But I think at the time we hated that hedge, and we thought,
Yep.
could we help these
We could
guys
take
get
it.
out of the hedge?
Yeah.
And look, I think we think Duketon's got more to go than what I think people realize. I think it's got good exploration upside there, and I think the other thing that we thought at the time was it wasn't really well disclosed how much capex they had. I remember there was all this
It was
confusion
a high
around
capex period at Tropicana, and we had the view that they were coming out of that.
and even at Duketon, they were moving underground, and they were spending a lot of money getting the undergrounds up and running. And we thought to ourselves, this is kind of a one-off, and only because it hasn't been kind of well guided to the market. The market's overreacting how much capital is required. So it was struggling to produce free cash flow. It was going through a
they were
capex
going to
intensive
spend
period.
at McPhillamys then
McPhillamys,
too.
yeah.
And they had
This is
McPhillamys in the
this is pre
pipeline.
McPhillamys getting next as well.
So look, I think there were a few things that I think we would have tried to help them with, but Jim does a good job. They're consistent performers, and I think they'll do well out of those undergrounds at Duketon, and I think there's more to go in that belt.
Yeah, I think we're just looking at going, this is a mature cash flow generative gold project trading at a significant discount. These opportunities don't come around very often, and they don't last very long. That was the high level driver, and then we got into the weeds.
One more for reflecting on. It has been I don't know what the right word to use is, but I imagine a bit of a roller coaster with your investment in Hastings, which is no longer an investment in Hastings. It's now we're talking about you own the shares in Air Performance Materials and a 60% interest in the Yangibana joint venture. When you kind of like go back to the deal you guys did, you provided the con note to facilitate Hastings to buy a strategic stake in Neo. Maybe there was a view to kind of bring it all together, and your instrument kind of allowed that to happen. And you reflect now, okay, you've got the shares, which you probably kind of cared about, and an interest in the project as well. But all of that said, would you still done the same deal you did back then to lend to Hastings?
Yeah,
the convertible.
It's an interesting one, more in the context of we're a pretty small team at Wyloo, and I think at the time we're just coming off of the Naront acquisition. We rolled into Greatland and Hastings, and then shortly after that did Mincor.
Yeah, we did Greatland and Hastings within a month of each other.
And I don't think we kind of realized how much we would be taking on. Like if you look at Wyloo today, it's 2 projects we own outright, a third project that we've got 60% in, and then a pretty sizable investment portfolio. And we're running it out of our Perth office of 20 people. And I think it's a very different kettle of fish when you're trying to operate assets versus just being an investor. Like running mines is a very different setup to just running a portfolio, and we run both. And I think that makes us quite unique because we're comfortable taking on assets and integrating them. And I think over the last 3 months, I would say on Hastings, when we first took over Naront, we had we didn't have the infrastructure in place to actually take on that business. And I think we've gone on a long journey as a group. Picking up Yangibana now it's really easy. We've got the systems in place. We've got everything we need to operate it. We've got the right people. And, could we go and do that again? Absolutely. We've got the platform to now be able to go and do those things, to be real operators. But then on the flip side, we've also got great investment people like Joel and his team and doing deals like Greatland. So we're a very, very unique setup, I think, in the mining space.
But as for would we do it again? Yeah, I would. I think we like that con note structure. I think for the reasons that that have played out now. I think when we originally did the deal, this wasn't the plan. This wasn't plan A. But it's a good fallback plan B. And
do you think like it made Hastings getting project financing a kind of, well, I know there's project financing kind of cover, but do you think it made them getting financing for that project like much more challenging?
Yeah, it's a good question because coming out of it now, I think unfortunately Yangibana has been a little bit tainted by the Hastings experience, and I think we've lost sight of the fact that this is a project that's had $200 million plus put into it. Yeah. It's fully permitted.
Nice tennis court.
Yeah, beautiful camp, beautiful airstrip,
roll.
big ball field.
The
one
trader site ready to go, cleared.
What was that about the camp, Luca?
beautiful camp.
A beautiful camp. Now that reminds me, JD, you see this Bell Tower Times article. Mining camp door slammer vows to intensify his efforts at spacious new FIFO resort. Now, mate, Big Dave sounds like a knob, but FIFO workers, they just want a room that allows a good night's sleep. Hear it from Paul Natoli himself. His grounded group knows this. That's why they build with acoustics in mind.
Yeah, so 7 years ago, I'd like to say, and we set out to do a survey to really understand what it is that FIFO guys and girls like love and hate about their camps. So we collated that data, right, which is very similar data to what we're getting today, funny enough. So it still hasn't changed or changed much. Comms, noise in rooms, you know, acoustics is one of the biggest things, the bed. So we called it the designer donga. What should be the new standard of living out in mining camps and remote communities?
Grounded gets it, so get with it.
The bit that really gets me is you go to these warehouses here in Perth and they're full of, there's 2 complete plants sitting in warehouses. Big autoclave. It's, you know, it's incredible. And, you know, you kind of lose sight of the fact that, you know, this thing could be producing concentrate in 18 months. It's unlike any other rare earth project around the world. Every other project's got, you know, years and years ahead of it of permitting, or it's in
$1
a
billion plus of capital required.
$1 billion plus of capital, or in a challenging jurisdiction. So I think we really like the Yangibana story from that perspective that, you know, if things keep going in the right way in the rare earth space, this is a project that's kind of turnkey and you can really get off the ground quickly. So,
I mean, one thing that we were, Hastings and Wyloo were keen to structure around in the initial investment was that we did not encumber the asset, so that it left the ability for them to put project finance against the asset. Just had a security guarantee against the Neo shares. Yeah, I think look, with the benefit of hindsight again, I think it, you know, that debt package did create some challenges. I also think that, you know, the initial idea was to see if there was something that could happen between Hastings and Neo, and you know, I listened to your recent Rare Earth Spectacular, and you know, the comment around the whole mine to magnet strategy being like a bit of a crazy one, and I think that it's true in a sense that if you're a rare earth mine developer thinking you know, create magnets, you've got rocks in your head. I think that's true. That's a very, very challenging pathway. It'd take you decades to get there. But can you stitch together a supply chain that takes it from mine to magnet? Yes, I think you can. And I think that was the opportunity that we liked. You know, for us now, having the obviously the guarantee over the Neo shares, we now have ownership of those Neo shares. Like, Neo is a business unlike any other. Like, it's such I've heard brokers describe it as like an enigma. They don't know where to classify it. They're not sure whose investment mandate it fits into. Broker coverage is a bit disjointed because it doesn't quite fit anywhere, but it is
Cool company.
It's a really cool, really interesting company. It's the only company of its type in the world, you know, and we focus so much on the magnets. There's sort of 3 verticals in there. The magnets one that gets spoken about the most. It's 1/3 of the company, but it is the only producer at scale of permanent magnets outside of China. Like, that on its own, it's just such a compelling story. It still blows our mind that it is a sub-$1 billion company, or probably isn't. It's had a fairly good couple of months.
It's still sub $1 billion. I think the other thing with Neo is, you know, like going through the kind of down cycle on rare earths, there was a point in time where it was the only cash flow positive rare earth company on all the global exchanges. And you kind of look at it and you go, this thing's doing 3 times the EBITDA of Linus, but it's got, you know, 1/10 of the market cap. And that's what we liked about it. And I think we picked up the shares at $8.60.
Yep. Currently
Sitting at about 40. So it's done really well. If you're asking us if we'd redo the deal, those numbers speak for themselves.
Yeah.
So.
Didn't Neo kind of, so the stake that you guys ultimately helped Hastings buy, you now own, they bought that off of Oak Tree, and Oak Tree's interest dates back to the kind of Molycorp.
Molycorp, yeah.
So,
It's like, gosh, the history of the company is quite fascinating. Like, it's had a few resurrections, and here it is today as this, you know, this producer of permanent magnets and magnetic materials and a bunch of really unusual, like, rare metals, the rare metals division, and catalysts and chemicals and oxides. So it's really fascinating business that we're still learning about.
Has your enthusiasm for like rare earth changed in the last 2 years?
I think I famously called it
Pixie dust.
Pixie dust
Pixie
with you
dust,
guys.
yeah.
It hasn't for me. I mean, I think every electronic device in this room has a little rare earth something in it. Doesn't have to be NdPr. It can be one of the other 17 rare earths. And I think that makes it quite special. I think more and more we're going to need these minerals. So I think the demand side for me with rare earths is different to the demand side on batteries. We spoke about different battery chemistry changes. Like rare earths, there's none of that. It's like it is what it is, and you need it across all these use cases. So I think from a demand perspective, I think still very bullish on it. Is it an incredibly hard sector to operate in? Absolutely. It's just very challenging where one country dominates 90% of the supply chain and really sees it as a strategic asset for the country, and that makes it incredibly difficult. But I think demand is so strong that dynamic will change over time, because the demand is coming through from all over the world. It's not just coming through from China. You're seeing it come through in Europe. You're seeing it come through in America, and those supply chains have to get off the ground. So, yeah, again, I mean, I think in terms of that investment, we got the Neo shares back. That's really covered kind of our initial investment, and we've picked up Yangibana. And I think a good reminder that Yangibana was a $600 million company, and we think it could go back there in the right rare earth environment.
Do you wait for the playing field to change, or do you just press ahead with development? Like a fair bit has been spent, but a fair bit more still has to be spent.
Yeah, I think as a private company, the nice thing is we can take a longer term view on things. So that's what we'll do with Yangibana. We've got our eyes on the bigger prize at the end of it. So once we get the keys, we're still waiting for the deal to fully complete. We'll have a look at everything, and we'll do the necessary work to make sure that longer term we're unlocking full value on that project.
I think first step is really reintroducing the project to the world, because it has been a little bit forgotten about. I think that there was a notable absence of any mention of Yangibana on the rare earths. We were talking about other projects, and I'm like, they're great, and like all of those projects need to get up, right?
Maybe indirectly, like maybe Yangibana can feed any ABBA.
Maybe
we can talk about any ABBA.
I mean, we talk about, has our enthusiasm for rare earths waned? Like, I don't think there's ever been more momentum and interest in it it sits at the intersection of, technology and geopolitics at the moment. Like, there's never been more interest. There's never been more politicians using the words rare earths in history. A lot of it's still not well understood, I would say. But, a fascinating discussion on the previous podcast, and I learned a lot from it as well. But I agree. I think that people are realizing, certain governments are realizing that it is they are commodities of national interest and that require security. I think it's one of the you guys have talked about this on the pod before, but the bifurcation became like a punchline. I think Rusty talked about it. It's like, everyone's teasing him about it, but like we actually see it. We have seen it in rare earths. Like end of last year, there was a restriction on Chinese exports of gallium. Ex-China gallium price was 70% up from Chinese gallium supply. Like that is a security of supply premium. And I think that
if you want to play that idea, you have to own Neo.
Yeah.
So it's
so I think it's a
ding ding ding.
Yeah, that's right. big ding ding ding. So yeah, I think that it is it's a really fascinating space to be in. It's incredibly complex, but the world needs more of this production of these critical minerals, and it needs the processing pathways and infrastructure. I guess the one thing that I probably did disagree slightly with in that discussion was like the tendency to discuss it from like what's like best for the world and like, oh, this efficient supply chain. But like the challenge comes when, at first contact, when companies don't just do things because they're altruistic and it's good for the world. Like there needs to be a commercial benefit to the company. I think that's a huge challenge here. Is like what's good for the country, what's good for the world. Companies need to make money. Trying to find that overlap in the Venn diagram.
I'd be thrilled if Luca decided to make commercial decisions.
No comment.
No comment. No comment. Well, I mean, like that's a project that, you know, once built will be a piece of infrastructure of national significance. You know, is there a pathway to make, like Australia, which has great rare earth deposits, to make us a serious player? You know, I think that is, you know, and governments putting on its critical thinking hat and trying to find interesting solutions to government's credit.
I think like rare earths, like in Yaba, it's like akin to the government having to keep a refinery open because we're not able to refine fuel without, you know, some kind of government support. I think in the future that's what rare earths will become. Like you will need this infrastructure. It'll be critical. So I think, yeah, I mean, we're supportive of Yaba. We'll see where it goes, but
Difference is there's a local buyer of fuel.
yeah, that's true. But you know,
That's true.
the one
That's
other thing
true.
just to remind everyone is, you know, you saw factories in Germany shutting down for, you know, a couple of weeks because they couldn't get magnets, and same thing happened in a Suzuki factory in
Yeah.
Japan. So, you know, our manufacturing industry here in Australia, as much as it's very small, is not insulated from that. At some point, you know, you're going to have a magnet in an Australian-made product, and you've got to be sure that, you know, you're able to actually get access to it.
We should totally talk policy because I do. You're not afraid to speak your views on policy, and it's wicked. Like I respect it a lot. I suspect we have some disagreements on views of like, desirable levels of policy intervention or desirable levels of government support in times of need and all that kind of stuff. But I mean, you guys have come at it from an angle of being like miners of critical mineral space, needing to grow a nascent industry, etc.
Yeah.
Why do you believe that the things you do about government and policy support around these industries?
From our perspective, it's not so much about government subsidizing industry in any way or like losing focus of free market principles, but the reality is in our space we do not operate in a free markets world. You know, there's very different standards around mining, and I think that's really starting to hit home a little bit. I think in all Western governments, I think there's been a massive wake up call in Canada, massive wake up call in Europe that you can't just go around blocking every mining project and expect to have a secure critical mineral supply chain. You also can't. I also think on an overall basis, it's not good for the environment either when we're not producing it locally or we're expecting too high a standard locally, but we're fine with buying products that are, you know, use Indonesia as an example. Got to tell the story, but like I saw this guy driving this EV saying, you know, it had a big green slogan on it, which is wonderful, but he was driving a Chinese-made EV, and I was like, mate, that EV's probably got the dirtiest battery on the planet in it. You think you're doing the right thing because you bought an EV, but little do you know how that EV is actually made. And I think that's the thing that I find needs to be resolved with regulation at some point. You can't have consumers buying a car thinking they're doing the right thing by the environment, where actually that car's not being produced in the best way. And we need to kind of close this gap we need to level the playing field if we expect our industry to be competitive between us and other jurisdictions. And that's either we lower our standards, that's not a good thing. So what we should be doing is lifting the standards around what can be sold in Australia. Maybe it should be the case that an EV that doesn't meet a certain environmental standard shouldn't be allowed to be sold here. And I think I've used this when I've done talks, is tariffs were, for me, a really missed opportunity. You know, you've seen 100% tariffs on Chinese-made EVs, and that's just protectionism. It's just protecting America's auto industry. It's protecting Europe's auto industry. I actually think there was a better way of doing it from a political perspective. You could have gone, hey, our auto guys have to meet this standard. We're not allowing them to do X, Y, and Z or damage the environment X, Y, and Z. Until you meet that same standard, you're not allowed to sell your product in this country. And then that would have just lifted the global standard. Where right now, all we've done is it's a race to the bottom. We've just gone to car manufacturers. You have to compete with the Chinese-made EV, which is really low cost. So you need to go find the cheapest form of lithium, the cheapest form of nickel, and make your product in the country with the cheapest and the lowest labor standards. And that's basically what we're telling industry. So it's just a race to the bottom. And that needs a massive fix, because you can't fix these industries or protect them through protectionist mechanisms. That is not a strategy that can last over time. You need to lift the global standard.
Yeah. Yeah, I mean, I think Australia's been so successful at mining that we're quite allergic to the idea of any sort of government support for mining. I think it's something that's in our nature. We don't like that just as a country. It's a not very popular policy. And it's been fine when we're dealing in iron ore and gold and things we've had a really huge competitive advantage at. Certainly cost structures have changed over the last decade or more. We're at a point now where having that sort of utopian view, or like that real purist view of free markets is like fine, as long as we acknowledge and consciously know that we're the only ones playing by those rules. Like they're, the countries and the jurisdictions we're competing with are not. We have this problem in nickel. People are like, oh, the government support for nickel, like it's unsustainable. It's like companies building projects in Indonesia getting a 15-year tax holiday. Like if Wyloo got a 15-year tax holiday, people would be in the street with their torch and pitchfork. So I think the role of government, and this is where I think I do agree with you, Trav, is like it's the nature of that support, of those government incentives or that government support. The nature of it is very important, I think. Not just a blank check forever, like that doesn't work. But I think the role of government is to support the development of industries that the free market on its own will not, for whatever reason. And now trying to unscramble that egg is really complex. But I actually do see that as being the role of government. It's to obviously facilitate an environment where Australian companies can, be as competitive as possible, but then also where that free market isn't working for whatever reason, try and implement a policy that does allow, where there is an industry of national significance, it to exist. Now, there are some that we are willing to relinquish. Automobile manufacturing, relinquish that. Are we willing to relinquish certain other industries? Like, I don't think we are as a country. I don't think we're willing to do that. No, and so I do have some sympathy for government. It's hard. It's really hard. It's not as simple, particularly in industries like rare earths that are super complex. It's not an easy fix. But I guess I do commend their willingness to really lean in and to put on creative thinking caps. And even if some of those policies are not fully thought out yet, they are at least a step in the right direction. But I agree with you. It has to be, it's not just any support's good support. It has to be the right form.
What about the approach of infrastructure? There's key bits of infrastructure that the whole industry could benefit from, aside from, going the much more targeted approach, which they've done in the case of Eneabba. Is that something you think about, like cheap, clean energy, or, bits of port infrastructure, road infrastructure being developed? Is that a spot where the government sort of left a bit lacking?
I don't know if it's I don't know if it's lacking, but I mean it's certainly an area that industry would welcome support in. There's a lot of talk about these industrial parks, and that makes sense to me. At a high level, if you can go to an area that the government's designated and said, hey, you don't have to do 3 years of environmental approvals because we've done it all for you, and you're allowed to do X, Y, and Z in this park, that helps. And I think I was looking at the GDP per capita growth numbers today in Australia. We have a massive productivity problem in this country. We need to be doing more. We need to be growing business if we want to maintain our kind of living standards. And I think government needs to think about policy and think about how they do things from the lens of how can we be enablers of that growth. I find government policies, and it's an interesting thing. You put something in place because you're trying to do the right thing. So you have a policy that's in place. You realize it's causing a whole lot of productivity issues, and then you try and subsidize the problem to try and resolve it. Where maybe the fix was actually to go back to the drawing board on that piece of policy that you put in place. So I think there's a bit of that. Well, and that's that is exactly it. A lot of the time, there's been overregulation. And the prime example is what we have in Canada, where it was just so overregulated mining that you basically put up a big sign to miners to say, do not come to Canada and do not build a new mine in Canada because you'll wait 15 years to get a permit and get shovels in the ground. Now, from our project perspective, we've done a lot of work working with the government to say, hey, here is the pressure points, guys. This is what you're staring down. And they had the biggest wake-up call of their lives when Donald Trump said, hey, we're slapping you with massive tariffs and we're going to make you the 51st state comments, right? There's a huge wake up call for them that they have to actually grow their economy. They have to grow their country, and they're doing a lot of work. And there's a lot of good things happening in Canada to actually be more pro development and actually. But being pro development doesn't mean lowering standards. It just means going back to the drawing board a little bit and making sure that what you've actually got in place makes sense and it's efficient. Because right now we have a system that isn't efficient. There's just too much duplication.
Yeah.
There's
I think
also
the duplication of processes was the main. Like, I don't think you'll find very many mining groups that are as pro sustainability as Wyloo. And in Australia, we are, Australian mining companies are generally like fantastic in that regard. But I think so. We go in there the best of intentions to try and develop a truly world class project that will look like a modern mining project in every sense of the word. But then. So the problem isn't that the regulations exist, because they should exist for good reason, right? There's a perfectly good reason. It's just like the overlapping duplication of policies at provincial level, which is state level, federal level, doing everything sequentially rather than in parallel. I think, it just meant that the timelines for development are so out of whack with the timelines for demand. You think, gosh, are we actually going to be able to bring this online in a meaningful time frame? And as you said, it was a huge wake up call earlier this year.
You don't have to stretch out timelines by March to completely
No,
erode like an IRR or
Yeah.
PV.
And I mean, you can kind of see it happening even on, the move away from kind of public sector, like not public sector, public money, so ASX money to more private capital. Because you've really only private capital has the patience to be able to go through that really long journey.
Yeah.
And I think it's something that in particular impacts our sector because they are so capital intensive and they are so susceptible and so sensitive to timelines. But yeah, and I think the one thing that I always reflect on is like I think as a nation, we've kind of lost sight of the fact that we are actually world leaders in developing projects and we're world leaders from a standards perspective. And I think we're I certainly get a lot of frustration is when you get an EPA decision that's taken a really long time and a lot of work's gone into it, and then it gets challenged. And it's kind of like, have we lost faith in our institutions that everything gets challenged again? And I think that cycle is really negative because, I think bureaucrats are even scared to make decisions because they know it's going to end up getting challenged. So everything just gets delayed because, and like in Canada, for example, when you apply for something, they have a fixed time. It's fantastic. It's like a decision will be made in 2 years. So you submit your document. It's 10,000 pages long because they've made you go through a million hoops. You submit it on day 1 year, 364. You get a reply from the government with here's 300 questions that you need to answer. And it's like, you could have told me these 300 questions 2 years ago. I would have had the answers for you and we could have all been moving along. But I think you've got this real kind of fear factor now in bureaucrats that they're really scared to be the ones to approve a project because it might get challenged. So for me, there's something in that needs to also be fixed.
And not to get too like philosophical, but we do talk about this sometimes, that the public markets in the Western world, in particular in Australia, have been great for mining. Like mining on the ASX has been wonderful. But sometimes we look at it now with in the hugely inflationary environment where capital costs are through the roof. It's actually a challenging market through which to fund development projects, which are very, very expensive. And the appetite for deferred returns or long dated returns is actually quite low. So I think it's a really interesting place to be private capital, which is how I think of Wyloo being private. We're a mining company, and then with a big investment, a very active investment arm that can act kind of like private capital. Because at the moment, imagine you're an ASX gold investor, and one of the companies that you're invested in has like a big development project. Like, I mean, that Regis is a perfect example. Like McPhillamy's getting canned. Might have been good for its share price. I mean, maybe not the only thing that happened around that time that made the share price go through the roof, but it's like, oh great, well there's a big capex bill off the table. This thing's absolutely printing money, and maybe there's easier, nearer term, lower cost, organic expansion potential here. But in like critical minerals, we want to bring new supply online, so it's very challenging. It's like, I'm not sure what the answer is. I'm not really sure I'm going with this this comment, but like philosophically, it's it's a challenging environment to be building these critical minerals projects.
I do think about that quite a bit, actually. And the
I
lens,
knew you would, JD.
the lens in which I think about it is you guys have a relatively unique position given the how well capitalized you are and the private nature. And I think about the super fund system here in Australia, and they just have a fire hydrant of cash coming in month over month. They have trouble deploying it. Do you think we're going to see them starting to take asset stakes, taking, they already take substantial stakes in mining companies, but even longer term kind of thinking and other potential, I guess, competitors to you guys in the space?
You see it a bit in the Canadian
Yes,
market. The
actually,
Canadian
they're a
pension
bit more
funds,
advanced, right? Like the Ontario teachers and things
they,
like that.
They kind of had the same issue, and then so they started taking direct ownership in usually large infrastructure projects. I think that's super dynamic. There's an opportunity in that as well. You very rarely do you see super style funds coming into projects early on, and helping develop projects. So yeah, they've got this massive funnel that they're trying to drink from. I think that industry will evolve, and I think there'll be pressure to deploy capital, and maybe you do see them getting involved in things at an earlier stage. I think with critical minerals though, and like in particular, nickel's different, copper's different, rare earths, very difficult because no one's got a clear line of sight of where prices are heading. So it's very hard to have a longer term view. And I think even, you see it in like the commercial banks as well. Unless you can hedge something there's a large ability to hedge it. Generally, you're not seeing the commercial banks get involved in funding projects. And this is again where I come to my point around you've then seen government try to step in as a funder, right? And government, this is not a natural home for government. It doesn't want NAIF and EFA and critical minerals funds. These are not like, this shouldn't be the role of government to fund projects, but they've had to step in because the commercial banks are not willing to do it. And within that, and this is Joel's other favorite playground, is even within that there's an issue because government wants they'll only lend you money if they can come in alongside a commercial bank because maybe they're relying on the commercial bank to do a level of due diligence alongside them. They're trying to crowd in funding. And I think that's so difficult when you're going, hey, I want to build my rare earth project or my nickel mine. I need you to have a longer term view on price. The commercial banks will go, no, thank you, unless you can hedge all the cash flows and I'm not at risk, I'm not interested. Then government goes, hey, if you find somebody a commercial bank to invest alongside you, then we can come in. You're kind of stuck in this no man land. And I think that's the reason we haven't seen a lot of government funds actually going into projects. Those funds are all still sitting on billions and billions of dollars of taxpayer money that hasn't really been deployed. And I don't think it's been as effective as what the government was hoping.
The evolution of the market is so fascinating. Like Andrew Forrest was one of the first people building Anaconda to not go and take commercial bank debt back in '96, I think. Yep. And that was pretty unheard of, going to the States, getting bond financing. And in 30 years, we've got to a place where seeing banks come in is like almost not unheard of, but we're heading that direction.
Yeah.
It's fascinating.
Yeah, it is.
The moment, it's funny, right? Like the government funding can unlock a project to become financed, but that in itself is clearly like there's an adverse selection problem here. Like a project needs the government funding piece to be financed, and it probably was evidently a marginal project. Like if the credit case requires the concessional finance.
There's a bit of that, but there's also a bit of like these markets are just also quite new. I think we've seen over the last 10 years people get a lot more comfortable with lithium, but in the early days of you saw Pilbara use Nordic bonds to build their project. That I think is changing in the lithium market. People have definitely got a level of comfort around it. I would say rare earths are almost unbankable. I don't think you'll ever get a commercial bank involved. Too challenging for them. So I think there is an opportunity for government to play a role in that space, but they need to fix those funds. They need to think about how they deploy their capital.
Yeah, not to be the pro-government guy as well, but I think this will be the first time I've been accused of that anyway in my life. But I think taking nickel as an example, I think the challenge that that the commercial banks will have is they'll have fixed policies around reserve tails or mine life and things like that. If you take Kambalda nickel as a very specific example, these underground high grade ore bodies, they extend at depth. So very few small and mid cap nickel mining companies are going to have drilled out 20 years of mine life from surface because it's prohibitively expensive. What they can point to is like a history of replenishment at depth. You mine, you drill from underground, you keep plunging down. So to government's credit, where some of those funds do work is they'll say, look, we'll come in alongside a commercial bank. The commercial bank will have a shorter tenor. We can have a longer tenor. We can have a more optimistic assumptions around resource conversion and extension. So I think that's where they're trying to play. The trick is always trying to thread the needle by giving a commercial bank sufficient certainty that it can get through its risk committee, and then obviously showing enough meat on the bone for the government fund to be like, yeah, cool, we can stay for longer, take these more optimistic assumptions. So, it's an evolving space. One that we do a bit of work in. Certainly wouldn't say we're experts in it, but I
think another thing that maybe distinguishes us from other groups is like, Andrew and Nicola are very passionate about this state and this country. And when we get involved in these discussions with government, it's more than just our projects. It's genuinely trying to see Australia being able to participate in these industries. So, yeah, and I think the government, they've, to Joel's point, they've done a good job. They've been quite creative with the way they've thought about things. But yeah, this is not an easy nut to crack. It's quite a complex space.
You guys ready to go introspective?
Yep.
Oh,
even more.
Yeah.
It's got very philosophical. I thought we were just going to talk about Greatland.
Yeah. The lights just dim in here. Yeah. Hit us, Trav.
Wyloo meant to be a miner or a strategic investor in miners?
I think we're a bit of both.
Yeah.
I think, as I said before, we're set up to do both now, and I think that puts us in a unique position. I think when I look at the portfolio now, I always say this to Joel: we've almost got the opposite problem of every other mine. We've got too much growth. We've got an awesome project in Ring of Fire. We've got Kambalda that we'll bring back online at some point, and then we've got obviously a rare earth project that we're trying to build as well. I think we're both. I think we're always going to have an element of investing, and we're going to Andrew's passion and where he really made his fortune was being a good operator.
Yep.
And having that, that culture that he created at Fortescue is really what we try to bring to assets. So I think we'll always have an element of both.
Yeah, absolutely. I think that obviously our two of our three projects are nickel mines at the moment, so it's sort of hard to say like, oh, we're operators. So obviously it's a challenging time for nickel, but that I think is in the DNA of the whole organisation and will never change. Like, we are not investment only fund. Having said that, and I'm obviously going to say this because I manage the investments team. I think that what are we really good at? The Greatland example is a perfect illustration of what we're good at. Is when there is, some sort of event driven transaction, we can come in and really put our shoulder to the wheel as a well financed group with commercial and technical capability and underwrite or through very many flexible funding structures, bring a new project into production, whether it's ourselves or whether it's financial support for another group like we've done with Greatland, whether it's in partnership like a joint venture with Hastings on Yangibana. Like, I do think that is our, I think that, really leaning into projects that we like with the full kind of weight of the group behind us, I think is what is sort of Wyloo at its best. Strategically, is it helpful? If we were buying something on market, do these guys want to own it, or is this just an investment play? Like, that actually is quite a strategic advantage for us. But I would say that that is not really a consideration 99.9% of the time. Normally, we've got a pretty clear idea internally of, what we're doing. So yeah, it's both of those, I think.
What is the future of green premiums?
Look, I actually really resent being associated with the term green premiums.
We've become, I think Rusty is still the poster boy for
Yeah,
it.
he
but
is.
maybe
He's
some
Mr.
players.
Price bifurcation.
He's Mr.
Yeah.
Price bifurcation.
Look,
for
and
sure.
I think I'm probably a little bit more in his camp as well. And it comes back to our earlier comments. I think there is such a big standards difference between how we're mining in Australia versus how nickel's getting mined in Indonesia. And at some point, that needs to be fixed. So I don't think it's a green premium that's voluntary, that someone's going to put their hand up and say, hey, I'm going to pay more than my competitor for the same thing. I think it will become something that's regulatory driven. And I think we see it in CBAM rules. We saw it at the G7. They're talking about a standards driven regulation around critical minerals. So I think it's not so much a voluntary premium. It's more a regulatory driven bifurcation.
Or it becomes like a point of differentiation. Like I have some, I think I can empathize with electric vehicle manufacturers that are, say you're a Western EV manufacturer, feel like pay more for these metals because they're green. It's like, hang on a second, I can barely turn a margin as it is, and I'm competing against, Chinese electric vehicles that are produced at a much lower cost. So no, I will not be paying more for the inputs. I think over time, as costs get closer to parity, then it starts becoming a point of differentiation. The challenge then becomes, how can you differentiate? Can you point to some international auditable standard that says X% of the materials in this battery meet this standard? And I think that's where groups like LME are getting to, working with industry to say, here is a agreed set of criteria that meet this threshold. These materials that meet this threshold will trade here. There's no requirement to buy on that exchange. There's no requirement to buy on that index. But I do think that over time, the two big changes will be 1, differentiation, and 2, regulation. Green premium, security premium, sustainability premium, whatever you want to call it. I think that, everyone will mock it until it happens, but it has happened. Like I used the gallium example earlier. Like it has happened when you have to pay extra to get it from somewhere because you can't get it from the other place. That's how premiums emerge. I think that I don't think it happens next week.
What do you guys think?
Yeah.
The bigger question.
We just commentate.
I think you said it really well. I think it's very hard when it's already higher cost to do stuff in the West to have that. And I think whatever shape it takes, it's got to be some sort of mandated policy. That's the only way it's going to happen. The cases where it's consumer led are too few and far between, and we're in a cost of living kind of crisis, right? And that's not changing anytime soon.
Even when it is government mandated, like I do think there's complications to the extent that commodities,
Can't track them.
And like you look at the tracking that does happen to, it's like tantalum in Rwanda, DRC or whatever, and there's actually quite stringent processes to track where things have come from, and traders have to be compliant through that all along the way, et cetera, et cetera. But what happens is, the coltan in DRC just gets blended with the coltan in Rwanda, and you get the threshold. And there's some trader that has like less stringent standards, and it goes via them because I just think to the extent commodities are fungible, and there are ways to blend and navigate via kind of those kind of channels, it will always happen, and that makes the premium very tricky,
very hard. Tricky. And I think that's why you do see mining companies wanting to move further downstream. Mining companies moving further downstream has been like a recipe for disaster for decades. But I think one of the ideas is that, well, if I can own this beyond it being a commoditized product, if I can produce like a Wyloo widget and then I can market that, then I've got a premium for that. But like you said, if I'm producing a commodity that's going to get blended with that commodity and some trader makes their money by that opaque, by buying from here, mixing it and selling to that guy, that's always going to be really hard. So I think that's why you do see groups trying to, have more direct relationship with their customers.
I think we've been too lenient on supply chains just in general. I mean, traders have thrived on that ambiguity for years.
Yeah.
And I think, look, I don't know where we're heading, but it's quite a sad reality because, if we're serious about climate change and we're serious about all these things, we can't have that race to the bottom. We can't just meet the minimum standard and that's acceptable. Like we really have to and this is the sad thing, is like we need globally as a people need to put our differences aside and agree that looking after the planet's important and we should be meeting a standard. And right now we're not.
Yeah.
We're just.
I mean, I guess that point I made earlier is that like we should be doing that, but then ultimately like people are incentivized by like
there's always
making
one
money,
guy
right?
who's going to cheat the system.
yeah.
And he's
It's
going to
prisoner's dilemma, right? It's like
You're not winning any friends in Switzerland right now with those
no.
sorts of comments.
No, no, no.
One other thing I've been thinking about a bunch, and you guys spoke about this years ago in the context of the Ring of Fire, is a mine of the future. And this could be a whole podcast, but designing a mine from the very beginning to be, you know, in the way in which the world is moving, autonomous and all these sorts of things. Like, do you think about that much? I know you still need to go through a lot of the permitting and these sorts of things and the process in Canada, but I think there's like the future is quite crazy to think about in that.
Yeah. I think like one thing I will say, as much as we've had an exciting year with Greatland and Neo and Hastings, like Canada's actually been our kind of unsung hero. Really going well there for us from a permitting perspective. We're just about to finish our feasibility study on Eagle's Nest. In terms of that kind of mine to future dynamic, I actually think it kind of, you know, when we took it over, we set ourselves, and this comes from our chairman really, the stretch target of making this the greenest mine that we possibly could. And I think having the benefit of going into it with that mentality from the beginning, we really pushed the limits of like what we're trying to do with Eagle's Nest. Now, I can tell you now with that mine, it's going to have a footprint of 1 square kilometer. I remind everyone that's like a little strip mall in Perth. It's not, this is a tiny little mine. We've been able to keep that footprint really small. Mining technology's come a long way. We're able to electrify everything. This is a mine that goes really deep. It goes to 1.4 kilometers deep on our inferred resource. We want to keep our ventilation as minimal as possible. So going electric really made sense for us. So I think, you know, we had that ambition from the beginning. It really challenged us. And I think it's one of those times where that kind of stretch target or that challenge actually resulted in a very, very good outcome for us, because the way the mine is going to get set up, this thing will be super low cost for its whole 17-year mine life. So deeper we go, everything's on conveyors and shafts. It's really low cost, even though we're getting quite deep. Where if we had taken maybe a typical West Australian approach, which was come in, smash and grab, truck and shovel, just get it out the ground as quickly as possible.
Eagle Nest is really high grade at the surface. It's like beautiful. Get in there, get it out.
Get it out.
Cash flow quickly as you can.
Great for the model.
You'll pay the price in the future, because it just starts to get expensive as you're getting deeper. So
the problem then is like you stop being resilient to low. Like that'd be great in so nickel rips, beautiful. Let's get in there. Let's start mining it. And then 10 years down the track, you hit another trough in the nickel price. All of a sudden, that's not resilient. And then you have to switch it off, and which has been the problem with Western nickel mines all around the world. Whereas you can design it in such a way that is resilient to those price swings.
Once that study's done, it'll be an exciting one to share, because it'll be a very unique setup the way we got that mine set up, and it will be ultra low cost. I think it'll be first quartile by quite a long way.
And some of the interesting like technical things like underground tailing storage, these are all relatively small things, and in some cases existing technologies that are being adapted or refined slightly. But the trend is only going one way with mining, which is it's getting more difficult to do things. There are more and more environmental concerns, usually for very good reason. So, to the extent that we can improve upon, pioneer, be the showcase for, as I said, the attitude towards having a surface tailing storage facility in a really remote location that's a very sensitive ecosystem is pretty low. So having underground tailing storage is not a brand new concept, but proving it up and deploying it at scale, I think could be really, really interesting, and it could be like a piece of infrastructure of regional significance as well. So that's something that we're really excited about, that our Canadian team's done a great job of, look forward to sort of sharing a bit more about that in the future as that study wraps up.
Is a Wyloo IPO inevitable in a long enough time frame?
Look, I think if you look at our portfolio, we've got a few $1 billion of capex coming down the line. So, look, I wouldn't put it out of the realm of the possible. I think the one thing that we're doing, which is good, is we're kind of wearing that really risky period for shareholders. And that obviously creates a lot of value for us as well. And that's what we're certainly doing in Canada. It's the way we're thinking about Kambolda as well. We're weathering this down cycle. We're working on how we're going to process our material. At some point, it could be interesting. And I think for me, Eagle's Nest is it's a world-class mine, but Ring of Fight that we're sitting on, what is it, seven ore bodies out there, all very developable. That's a word, developable. And I think for us, Eagle's Nest is kind of the first cab off the rank, and just this amazing mineral basin. And then you kind of got Kambolda. We're actually quite uniquely placed in the nickel sector. We've got a Nova style asset which survives kind of peaks and troughs. That'll be Eagle's Nest. It's a mine that you'll probably never switch off, and you'll just wear the cycles. And then we've got an asset in Kambolda which is really cheap to switch off and easy to switch back on, that you bring on when the cycle's really good. So we're kind of playing the nickel game in two different ways, and I think that's quite unique exposure. And right now it's a tough sell in nickel, but there'll come a time where nickel will be going well again, and people will be looking for that. And where do you find it in the market? You can't really get nickel exposure.
Yeah, I mean, I'm looking at the Lassonde curve on JD's shirt, and I think that there's a period with a big project like Eagle's Nest, which is sort of complex and takes a lot of permitting and studies. There's a period where it's great to be private. It's a period that we're in right now. It's deeply, deeply unsexy. Not a lot of.
Put out a study with a capex number,
right? It's like there's we can't. We haven't got exciting news to put out every quarter around Eagle's Nest, right? And I used to joke that if you could privatize every mining asset at this point in its cycle, you would, because you can just diligently go about the work without worrying about the next quarterly or having some great announcement, having to raise a bit of money to keep going. So it is, we were talking earlier about all the benefits of being private, and there are a lot of them. But having said that, possibly that's something that we sort of have spoken about. I think that we're assembling a really interesting portfolio of assets. We've got the ability to move counter-cyclically, to move pro-cyclically, and we are establishing a interesting portfolio. Whether you do it for the whole group, whether you do it for some parts of the group, we talk about. But certainly at the moment, with a big project like Eagle's Nest, great time to be private. This means that you can. How often do we see? I mean, you guys talk about it on your show all the time. How often do you see corporate actions, corporate decisions that are made that are long-term value destructive, but just to meet some near-term objective? It's so common. You show me the incentive, I'll show you the outcome. And I think one of the good things about being private is that we can keep our head down. We can do things diligently. We can do them in ways that are going to unlock the greatest long-term value. And we have seen that at a really granular level when we have, come into companies and change the way things are done. You're like, why was this being done like this? You realize it's because it accelerates things. It brings forward cash flow, or we didn't have the money to do that, or we couldn't justify the budget to do that. There's a great benefit to being private at certain times. There's a great benefit to being public at certain times. So I think it's just about assessing that on its merits as we move forward.
Awesome, guys.
Would you buy shares?
You want some of those warrants?
I'll buy some while they're private now, and then in 10 years' time with the nickel cycle, I'll just realise a paper gain of some sort.
Yeah.
But,
Should we finish up with an underrated, overrated?
Ooh.
You guys ready? We haven't done this in quite some time,
Gosh,
so
I'm nervous.
we had to get creative. One sentence or whatever sort of comes to mind can be your response, and we'll go back and forth a bit. Underrated, overrated, WA hard rock lithium projects.
no one
I'm
wants
not
to
sure I
answer
have.
this.
I'm not sure. Oh gosh,
Maybe I
it's
should
a
pick
$1 billion
one of you.
question. You should have warmed us up to one.
I think underrated.
I think-
I think
yeah.
our perspective on it is underrated. I think until you see DLE really finding its
Yeah.
traps,
I'm going to go with a soft underrated call. I feel like lithium there's a few things in lithium that are, this is not a one sentence answer, that could be quite binary that I definitely don't understand well enough. But I would say underrated on the basis that I think it's all been hit too hard.
Vanadium.
I've got a soft spot for vanadium. I'm going to say underrated. Vanadium flow batteries are not a novel or new technology. They are used around the world. I think that they have a compelling use case in Australia.
yeah, Underrated. I think we haven't seen that tech really find its feet yet.
PGM operations.
Biased,
I'll
underrated.
let the South African answer this one.
I think huge kind of headwinds there, and I think still a huge use case for PGs, and everyone's kind of ridden it off too early.
Yeah. I think that the byproduct nature of PGM production is sort of a complicating factor, but we're certainly seeing disruption in that market. Does that make it underrated?
Eagle's Nest is 5 grams per ton PGs, so just
that's underrated.
I had heard there was a credit.
Yeah.
Royalties.
Owning them or paying them?
Hate
Owning
them,
them,
hate
underrated.
them.
Paying them, overrated.
It's an easy one.
Look, I think
We're unfortunately on the wrong side of them too often. So
overrated. Yeah.
Fair enough.
I mean, maybe you can buy some. Like,
Yeah. I mean, look, I think that like all sources of capital, they have a use, but they can be absolute killers and have been the absolute. What you hate to see is a project that should get up that doesn't because there's a royalty on it.
say overrated because everyone has this idea that they're not dilutionary, but they are the most dilutionary thing you can possibly do to your mine.
Yeah. Another commodity one, graphite.
Overrated.
Overrated? Yeah.
It's
That's
funny
simple.
because I don't think it's rated too highly, and it's still
No, yeah, probably rated.
Correctly
Probably rated.
rated. Yeah.
Rated. Just tough, and that's not a knock on anyone. I find it a very, very complex commodity. The natural synthetic interplay, I think, is really challenging. I think that there are some interesting pockets, though. Having said that, I think some really interesting pockets. And I think again, if you can differentiate so that you're not just selling a commoditized product, I think it's interesting.
private equity applied to mining.
Applied to mining. I know your answer.
I think it's for me it's overrated.
Yeah.
Just these are mining is long dated, and
That's-
even these funds with longer lives really struggle to do what they have to do in the time frame they have.
Yeah, I mean, it's the mismatch of fund timelines with mine development timelines, which I think can be really challenging. You can see funds that might really like a project having to sell their position because their fund's closing, even though they still like the exposure. So I think
The growth of battery energy storage systems, stationary batteries.
I think underrated. I think we're moving into a really difficult energy period where we're consuming so much energy for AI technology reasons, and I don't think we have a solution for where we're going to find this energy, and we have too much conflict at a political level.
rated.
Corporate raids.
Underrated. Great fun.
Fly the flag.
Overrated because they're much harder to deal with
Yeah.
than you think.
Yeah. Yeah, I mean, it depends what you're doing them for. If you just try and make money. I mean, we were that close to an absolute stonker. So,
Why are they harder than you think? Because I mean, like you never see them.
yeah.
Go back to the 80s.
Yeah, I mean, I think that there's also there's not a great willingness to do it because it makes you deeply unpopular.
Mm.
I think picking up the pieces is what's challenging afterwards. So it's challenging. It's better ways of doing things.
Yeah, I think so. I mean, the Regis example is a good one. I think everyone assumes naturally that you like don't rate the company or management or something like that. And in that case, it's just like this is value.
That's funny how like people's brain go to that because my thoughts is just like no, you want to execute
Yeah,
like very quickly at a set price.
yeah,
And you think there's a discrete window to do that.
that was it.
How about the hype around hybrid vehicles? Underrated, overrated?
He's got a strong view, but I go. He's got a very strong view, as you can tell. I say overrated as well.
I think overrated, massively overrated. I think I totally understand why they are attractive right now, but I think that who used the example of it being a sailing boat with a steam engine or a steam engine with sails on it. I think that like ultimately you don't want to hedge your bets. You don't want the worst of both worlds, you want the best of something. But I understand that in certain countries where infrastructure is currently where it is, it's a useful product for right now. But I don't want one.
I think battery tech gets so good that
Yeah.
you don't need that really long
Stepping stone.
mileage. And I think if you talk to mechanics, they hate working on them because it's just like the worst of both worlds.
Yeah, you got everything jammed in. You got both technologies jammed into this small space. I'm also like, I don't drive long distances in one go, very, very rarely. So I think that's for my life. I don't see it, but I appreciate that there is a use case for some folks. But generally, I think it will be transitional.
This is fun. We should do our
This is
investment
great.
committee like this.
Yeah.
Thumbs up, thumbs down.
Well, yeah, I don't know. That's
The propensity of the majors to lean into diversification towards fertilizers.
Very specific question.
It's really only two, like Anglo and BHP.
But I say overrated. The story around fertilizers and growing populations, etc.
Any chance to put the gloves up to BHP? Like,
yeah.
No, I mean, in the early days we were looking at SOP projects and things like
Yeah.
that, but we just haven't quite seen it
Trevor knows the
actually. Yeah, we haven't quite seen it kind of find its straps or actually, that kind of big growth story really happen.
Yeah. I mean, I also do like the ambition to lean into a different industry that requires scale and a lot of investment. So like putting the altruistic hat on, is it good for the world? Probably.
I think they'll make money out of it
Yeah, I think
at some
so.
point in the cycle.
I think so. I think like BHP has realized like, large scale bulk operation, that's what we're good at. Let's do that. Really squeeze the lemon. So
Love Travis's face. Tell us what do you think?
I have to like stop myself from talking sometimes.
BHP's in way too deep anyway.
yeah, it's, I mean, they're doing it. Yeah.
Thinking kind of jurisdictionally, what do you think of the emergence of Saudi Arabia as a mining hub?
An investment hub or an actual mining location?
Well, they want people, sharing tenements, looking.
Is this the right word? Underrated in that, I think for a long time you'd see little junior mining companies being like, "Well, we're getting investment from Saudi." I think it's very real.
Yeah.
I think that the money getting deployed by Saudi is real. And I think the effort to go and explore that country is very real. And we've seen it. We've seen friends join Saudi companies. You see them at conferences. Like, I think it's genuine. So
Yeah, I mean, I think that if you ever make a case for governments taking a long-term view, I mean, that's the case in point right there. That's belief in the energy transition. It's like we need to diversify away from fossil fuels, even if you think it's still got another 20, 30 years to run. And they are doing it. They don't do things in small bites. They take a big swing. So yeah, it feels real. Probably appropriately rated at the moment.
That's the right way to frame this. Do we focus on cost curves enough?
I don't know. Is this how do I describe this in over and underrated? I think we focus on it too much because I think the market doesn't behave. It takes what the cost curve doesn't take into account is how long somebody's willing to wear losses.
Yeah.
And because
It's dynamic, it's not static.
And because we're in a mining world where you might be subsidized by your government to keep going because it's important to them, the cost curve means nothing because you're being funded to your losses are getting funded.
Tell you what's underrated, appropriately adjusted cost curves. Because like cost curves ain't cost curves. So it's
Doing
like what's
things on
the,
an equivalent basis. Yeah.
that's underrated.
What's left out? Aren't they adjusted properly?
Rare earths, horrible. What product are you using? How hard is it to get to that actual product?
Yeah.
Everyone's making something different. Nickel, same thing. There's 10 different forms of nickel. Which one are you using?
Yeah, so I think just comparing apples with apples is challenging.
I've got one last one. Tin.
Haven't spent
I don't
enough
know
time on
enough
it.
about it,
But we've looked in the past, a couple of years ago, we had a crack at a few things and incredibly difficult to find assets. So I'd say underrated just on not knowing the market very well, but knowing how scarce those assets are.
Awesome. What he said.
The entrepreneurial mining spirit in Australia.
I think best in the world.
Yeah, I think it's great.
I think we
Adequately rated.
Adequately rated.
No, hugely underrated. Hugely
never be
underrated.
Yeah.
I think when you look at those those kind of mining jurisdiction ratings, and like we should be number one by a long margin. I think we've got the best mining people in the world by far, and I think we've got very, very entrepreneurial people as well. It's not just down to there's a lot of good miners globally, but just the ability for us to get into challenging terrains, roll up our sleeves, just get on with it, be clever, be smart, do things inexpensively, being efficient, the culture. Like we said this before, like difference between Canada and Australia is like a jumbo operator, and Australia is like a paid assassin.
It's like a mercenary, right? It's like I am the best at this. I do this many meters a day, and I'll go down the road and do it, right? Because that's how good I am.
It's hard to find that anywhere else in the world.
Yeah, I think it's massively underrated. I think that it's not just the entrepreneurial leaders, the Andrew Forrests of the world that we obviously think of them naturally, but it permeates down to the attitude at the operations, and I think it is the best in the world. These are the industry builders. These are the people that actually bring new things to market, and it's great to see like a new generation coming through as well. Great to see the emergence of new companies, and I spare a thought for the lithium guys who've actually executed really well and just been on the receiving end of a crappy commodity price cycle. I think of Liontown that executed a project on time and on budget.
It's a good example, lithium, because it's challenging to permit projects in Australia, yet we went from 0 to number 1 in the world pretty quickly.
Yeah.
Where like we look at Canada, we have some really good ore bodies, and in that whole time period failed to build a single lithium mine.
I think the third or fourth like best sort of viewership of this show might be Canada. So we'll have our Canadian friends.
No, look, I think they definitely Canada's on a journey at the moment.
Yeah.
But I think, it's jurisdiction's one thing, but the people are something else as well.
Oh, I got to say one last one. The most underrated place to be allocating capital right now, be it location. No, you got to say location and commodity. With a long-term patient view.
Yeah. I think this is a pretty boring answer, but I think it's probably South America and copper. I just think that the projects there are going to be enormous, and it's been interesting to see, cooperation, I guess, for want of a better word. Thinking about how we can bring.
I was also making up words on the spot.
Yeah. How you can bring a bunch of projects online together that are probably going to need to share infrastructure. I think but that requires a huge investment of capital over a long period of time.
I've spent this whole podcast talking badly about Canada, but I'm actually going to say Canada. I think the change that's happening in Canada
is hated. It's people are bearish about it. If timelines condensed, then that's a big.
I reckon the shift that's happening in Canada is very real, and I think it's reputationally not where people want to go. And I think that's, for me, why I think it's underrated. Where I think something like South America is it's
pretty well saturated,
pretty heated. Yeah.
What commodity I'm interviewing now?
I don't know. Lithium, nickel. I think they're ripe for production there. Especially maybe more lithium than nickel. Really, nickel, it's us. But that lithium triangle up in northern Quebec and
the James Bay lithium projects are like, again, it's similar to the South American copper. It's like there's a bunch of kind of disjointed ownership of lithium projects. They need an infrastructure solution. There's probably an avenue where you can bring a couple of groups together and unlock the whole region.
Guys, this has been awesome. Thank you so much for making the time and coming on Money Mind, spending 2 hours chatting with us.
Oh, thanks for having us back. It's been good.
Thanks, James. This has been awesome.
Went a little deep, but
it was great. Went real deep. Yeah, it was great.
It was wicked. I appreciate the transparency and the candid nature with your responses, and the ability to kind of unpack how you both think, and commend you on the journey you've been on, and excited to see what Wyloo kind of continues to grow into.
Thanks. Hope we can come back.
Keeping you on that chairman's list for when we IPO.
That's right.
Awesome, guys.
Thanks, fellas. Good one.
I've got nothing more to say, mate. That was a special conversation. And I'm just very grateful to the guys for coming in and speaking the way they did.
Absolutely, mate. What a wicked conversation. We hope you all enjoyed that one as much as we did. And a massive thank you to Mineral Mining Services, Grounded, Sandvik Ground Support, and Cross Boundary Energy.
Hooroo.
Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.